Thank you.
Well, that's.
I'm tempted to weigh in, but I don't think it's appropriate for the chair to weigh in. Gail.
Thank you. So I don't have the same question because that was too depressing. But could you, Mika, on the peer review, what are what goes into the measurement of comparison?
Sorry, a great question. So what these universes do is take all of the funds, and again, this is using State Street's portfolio, so meaning all groups that they custody. They're pulling in any fund that meets the criteria, so either all public funds, and then you see on INV 105, it's public master trusts over $1 billion, and then on 106, public master trusts over $10 billion. I think an important thing, and I neglected to mention it earlier, and Chris probably was trying to kick me from over there. What you do see at the top of each of the tables is the number of observations. That's telling you how many other funds are included in each of the various groupings. And I think that's important because, as is probably intuitive, as you move to that over 10 billion group on 106, you see there's only about 23 funds that are large enough to be considered there. So as the group gets smaller, the data you have to be a little more careful with, right? Because the spread can really meaningfully impact it. I think when you're looking at on 105, the public master trust over $1 billion with about 100 to 130 different groups, that's a large group. But again, $1 billion trust has a completely different set of objectives and set of possibilities in terms of what they can invest in and how they can implement a portfolio. So really, you can get kind of a mixed bag there.
And do they all have such huge liabilities? I mean, many of these can't have the kind of liabilities we do in terms of.
Smaller on an absolute basis because of their size, but I'd say in terms of funded status, you probably have a pretty big mix of underfunded plans in this group. There aren't a lot of especially well-funded public funds that I've seen.
Yeah, in the ballpark.
Yeah.
The other thing on a universe is those numbers are gross of fees, so you'll see a different number in the universe comparisons than in a performance book, because the performance book, the returns are net of fees. And so there's a difference, and if some of you try to foot the two, they won't foot, and that's the reason why.
Right.
And you see disclosures on here, I think, gross returns based on best available expense information. The reality is, in the private equity space, other areas, it's really difficult to gross up returns. It's also difficult to get perfectly net returns, so you're always making a compromise. This tries to do it in an equitable way across portfolios.
Right, but probably true that.
And what it doesn't really show is the impact of asset allocation. Yeah. And really the big difference between, in most periods, will be how people are allocated by domestic and international and how much they have in private markets. And so in periods when private markets do well, I have two clients that are very, very large that have north of 20% in private equity and north of 10% in real estate. When the private markets do well, they're in the first percentile.
And then I do actually, speaking of allocations on 94 and 95.
Yes.
Although the peer comparisons, I do think speaks to your wisdom, Mr. Emkin, about not being too confident in those. So on 94, what are innovative strategies?
The innovative, I see Chris pushing his button. I'll let him.
Chris Ailman, Chief Investment Officer. Innovative Strategies is a subgroup that we created a couple of years ago by the board to basically test drive ideas and research things that fall between the asset classes or do research in association with the asset classes. There's a zero allocation to it, but the board assigned a 0 to 3% range. We didn't include it in the asset allocation because it's tough to figure out what return that pool is going to get. The goal for that team is first and foremost to find things that diversify the fund and enhance the return. I always call that's kind of the golden goose. I think we'd all know if those existed. The next is to find things that diversify the fund, or third, to find things that could enhance the return. We're always going to keep that fairly small, around 1 and 1.5%. They test drive things for about 3 years, and at which point we kind of make the fish or cut bait decision of grow it up into an asset class or we move out of that strategy. But it's an incubation. I remember originally Stephen Tong, which used to run the room, came up in a white lab coat with safety goggles to try and emphasize they're a 3M lab for us of test driving things. And some of the best work they've done, frankly, is researching areas and deciding not to invest in them and helped us avoid some pitfalls.
Do you have an example of a successful strategy?
The most successful strategy is really RMS. All those, certainly the two strategies were tested in those, in the innovation team, and then that with the work from Makita and back then PCA at the time, then it became actually an asset class. And they had built those strategies, even though they're very small, around $1 billion, they had built them on a platform that could in essence withstand a full asset allocation. So we were able to scale up within 18 months.
That's great. And then in the future on this, as we move towards a risk budget, would it be possible to kind of put the risk ability to include it in this review? Just in addition to the weight, the benchmark, and then the risk that we were working in?
If
Would
the
that
board
make
moves
sense?
forward with using those tools, the risk management tools, then that would literally change this report. And it would
great.
focus on those metrics and getting the board and the staff and the consultants on the same page, what the metrics mean, how they work, or where it's adding value and it's not adding value. So this report would change significantly.
Okay. I do think, and I know, Mr. Chair, you gave a lot of this time to this last time, but I do think sort of measuring risk and benchmarks together does draw a more complete picture and at least as I'm learning, feel a little bit less arbitrary than just the benchmark and the weight. And then on the asset allocation, and this is my last question, and this may be not a fair question, Mika, but vis-a-vis sort of what we talked about today, this is a snapshot of, where we've been. Obviously, this is a net, unlike the comparisons to our peers, the gross. Can you just kind of speak to how you think this leads to the recommendation at 7% where we've been?
So I think, the 7% recommendation in terms of asset allocation is driven by the actuarial assumed rate, your needs for being able to grow this pension over time and pay benefits. In terms of our confidence that 7% is a realistic assumption to use, I think INV 93 is helpful, but also staff puts together a nice snapshot on INV 199 that actually goes back 30 years. And you can see that your 30-year historical performance has been 8.1% a year annualized. So I think if that's a pretty long time period. It incorporates a lot of market environments. The future is certainly not going to look like the past, but I think we believe that with the diversified portfolio that's being proposed, you have a reasonable likelihood of achieving 7% over time.
And then one more question for November, and I'm sorry. Would it be possible to just do a summary of private equity through those 30 years then? Because that's the piece I don't. Am I missing that?
The time
Is that already on here?
performance?
Yeah. I mean, I see it 16 through 19, but just in terms of relying heavily on private equity over a longer period of time. And understanding that the past doesn't predict the future always, but.
That might be in the, I think it's 5C, the private equity presentation, so.
Oh, great. Okay. Thank you.
But if not, we'll circle up and make sure
Okay.
that we get that data.
Thank you, Mr.
You're
Chair.
welcome. Ms. Miller.
Ms. Miller, I think that there is information on the report on INV 93 that really ties directly into your question. And when we look at the numbers, we're less certain about the precise expected rates of return and risk. What is really most important to us from a strategic asset allocation is the relationship of the assets. So which asset is the best return? And literally, if you look at 10 years, private equity was by far the best, followed by public equity, followed by real estate, followed by fixed income, followed by cash. So in fact, it gives you an insight into those relationships. And it's those relationships which will drive the asset allocation much more so than the numbers. Because as long as you assign premiums based upon history, then you'll end up with a portfolio that, as we discussed, will give a significant weight to private equity because it generated the highest rates of return over time.
That's really helpful. Thank you.
Ms. Miller. Mr. Prasant, Bill?
Thank you, Mr. Chairman. Going back to the strategic class attribution, gross of manager fees, with regard to private equity and real estate, both of those showed a positive, and that's including, that is gross of fees. Has there ever been, I mean, do we have a number for net of fees? Maybe I misunderstand.
So we're looking at INV 94, correct?
Yeah.
Yeah, so in terms of, I think that you mean put into dollar terms, do we have the net of fees dollars? It could be done, it is not done in the current reporting, but I think that it's possible. I'm just trying to.
I mean,
Important to keep in mind that most of the fees, in fact, do get netted out in private equity and real estate before we do this calculation. It's not like the public markets where there's a distinct fee. Literally, it's being taken out of the asset return. And so the numbers in here pretty closely reflect the net rate of return.
And I would say, Chris Hellman, Cal's Chief Investment Officer, the State Street money numbers in detail are net of fees. We'll work with Makita to try and make sure this report, we normally like to show you net of fee numbers, not gross of fee
yeah, no,
numbers.
that's what I was.
The very last page, as Mika pointed out, 199, that staff report is net of fees.
Okay, sorry.
And net returns always. The board asked us, gosh, about 5 years ago to always state things in net returns, so not sure how we let that one get by.
Yeah, no, that chart is gross of fees, correct?
Yeah.
Okay.
94,
Yeah,
clearly says
94,
it's gross
yeah.
of fees, because it also says we had a 7.1 last year. I'd love to have 7.1 last year, but it was 6.8.
Bill, is that?
We'll work
That's
on
it,
that.
thank you.
So, Chris, I was going to make that point, is I don't know what has to go into the efforts and the work, but the expectation is that when reports are presented to us with numbers, we want them to be net of fees and consistently net of fees. So
Yeah.
whatever has to be done to get that, I think that's just in everyone's interest for clarity and is actually the real number, right? So that's what we need going forward. I don't know what goes into making sure that that happens. It might be some additional work, but I think the committee would benefit from that. Chris?
Both staff came up to me and reminded me that the page before, Bill, one INV 93, that is, which is the one Mika pointed out earlier, a more important one on 10, 5, 1, and 3, that is net of fees. We can change that attribution page
Right.
to make it net of fees as well.
Okay. Bill, is that clear?
Yeah. Sorry.
No, it's important. It's something that
Yeah, we've actually had this
we've
conversation.
talked about. It's very important. We want that. Okay, good. So that's the semi-annual report from our general consultant. Next item is, and I know we have to receive the semi-annual reports. We'll receive them all at the end of the 3 items. So RCLCO, come on up, please. Our real estate consultants, the semi-annual performance report from RCLCO, Taylor and Mammon and Ben Maslin. Welcome. And please, guys, if you could reference page numbers, if you're referencing numbers, reference the page numbers for us to follow along. Thank you.
Absolutely, and we'll primarily be walking through the presentation, which you should be able to
PowerPoint.
see at this point as well, the PowerPoint presentation.
Yes.
So, thank you, good afternoon. I'm Taylor Mammon, Senior Managing Director at RCLCO.
Ben Maslin, Managing Director at RCLCO.
And just by way of introduction, hope that this high-level summary is helpful to you as it summarizes what is in the report. We think it's important as your primary monitoring tool, in addition to informal conversations that we might have of in order to oversee the delegation that you have given to staff to make investment decisions. And so we're, of course, going to talk about the performance of the real estate portfolio relative to expectations and what we're seeing in the market as well. And in closed session, we can go into more detail about specific initiatives that staff is undertaking as well. Before we got started, I wanted to address Board Member Yee's question from earlier regarding the long-term or the historical performance of real estate within the CalSTRS portfolio, particularly as it relates to the allocation study going forward. So as we were sitting back there listening to the question, we really identified three primary and significant differences between the portfolio as it exists today and how it looked in the past. And those include, first of all, significantly lower leverage. As Ben will talk about in a moment, the leverage ratio within the overall fund is very low, potentially 20 to 30% percentage points lower than what it was prior to entering the previous downturn. More importantly, the portion of the portfolio that staff has control over, meaning they can make acquisition, new investment decisions, as well as disposition decisions. They retain those rights, has significantly grown. We'll talk about that as well. And in fact, it was that lack of control over going in and going out of investments that likely had the largest negative impacts on overall investment returns during the previous downturn. And then third, I'd say the portfolio is just simply more institutional by nature, and by institutional I mean it is more comprised of stable income-producing assets that are of higher quality and are more liquid. They're in markets where there's always going to be demand for those types of products and products that are always demanded as well. So just wanted to address that and can, of course, answer questions about it later on. But before we get there, wanted to turn the time over to Ben to talk about the fund's performance.
Yeah, hi. Good afternoon, everyone. So one other introductory note about our report is that our data is as of March 2019. So there's a 1-quarter lag in terms of getting the private markets data for real estate. This is also for private equity. So everything that I'll be talking about here will be as of March of this year. So looking at the funding status and compliance of the portfolio, the allocation to real estate as of March was 14.1%. This is a little bit higher than the target of 13%. It's down slightly from the end of year, which was 14.2%, but up significantly from a year ago at about 12.7%. So slightly above target and higher than it was a year prior. And the fluctuations in the allocation are due to a couple reasons. One is that there's been volatility in the global equity markets, which is the largest asset allocation within the portfolio, whereas real estate has generally been quite stable. If anything, it's actually appreciated over this time period, while there's been volatility in other asset classes. Secondly, I'd say that today what it looks like is that the portfolio is at about 13.4%, so very close to its target, so it's declined. And that hasn't been due to declines in value. It's been due to strategic dispositions of open-ended funds within the portfolio. There's also been a rebound in the value of global equities over this time. Looking at the compliance of allocations within the different strategies within real estate and leverage, there's really three overarching strategies within real estate. One would be core, which are the least risky assets. These are typically assets that have stabilized occupancy rates and rental rates. Value add strategies include some level of risk, so either repositioning the physical structure of the asset or taking on leasing risk. And then opportunistic assets are the most risky assets, and they can include speculative development as an example. The portfolio is in compliance across all these, the allocation across all these strategies, and more than 2/3 of the portfolio is in core assets, so the least risky assets. Taylor mentioned a difference in the composition of the portfolio today versus pre-recession, and one of the big differences is the level of risk in the portfolio, where a larger percentage of the portfolio was in opportunistic assets in closed-end funds, which we'll get to in a moment. Today, that's less than 20%, less than 15% of the portfolio. Similarly, leverage is lower. The core portfolio is currently at around 30%, well within the policy limitations. The value add portfolio is less than 50%, also within the policy limitations. And there's no policy limitation on opportunistic assets, but it also has a relatively low leverage ratio compared to the pre-recession numbers. Looking at returns, the portfolio has exceeded the benchmark Odyssey index for every time period. So drilling down on longer term returns, the portfolio has exceeded the index by 70 basis points over the 5-year period and 50 basis points over the 10-year period. Now, we looked at this two ways. One is the total portfolio, and then two includes what are described as legacy assets. And these are closed-end, commingled, opportunistic funds that were invested in prior to the recession, which have consistently had a drag on portfolio returns post-recession. So again, looking at the difference between how the portfolio was allocated pre-recession versus post-recession, a much significantly greater percentage are not in these types of assets, and these assets are burning off as capital is returned over time. And so when you exclude legacy assets, the portfolio has outperformed the benchmark by 230 basis points over a 5-year period and 250 basis points over the 10-year period.
And just want to make sure we're noting these are net returns that are shown on the slide.
Yeah, thank you. So the control of the portfolio is an important distinction about where it stands today and where it was pre-recession. So today, approximately 80% of the portfolio is allocated to structures that can be considered as within staff's control. And these include open-ended funds, separate accounts, programmatic joint ventures, as well as investments in real estate operating companies, where staff has control over entry and exit into all of these assets. And for the majority of these assets, there's additional levels of control in terms of leverage and other major decisions. There's also greater transparency into the assets, into the portfolio, and typically there's actually significantly lower fees as well than a commingled fund structure or non-controlled structure will offer. This is a significant increase. It was approximately 46% of the portfolio was non-controlled in 2000. Was controlled in 2010. So a significant increase over the last 10 years. The legacy portfolio I mentioned a slide ago is burning off. Today it comprises just 5% of the portfolio. This is down from 15% a couple years ago and nearly 50% in 2011. Looking at where capital, the unfunded commitments are, the vast majority continue to go towards core properties and controlled structures, with 2/3 going to controlled structures and 2/3 going to core value add risk structures. With regards to the property types, the two largest unfunded commitments are to multifamily and industrial properties, which have been the best performing property types in within real estate during this cycle, and we believe to continue to be the best performing property types going forward, given the strong fundamentals and demand drivers of those two property types. I'll turn it back to Taylor to talk about the market.
Yeah, just wanted to spend a couple of minutes talking about market conditions, again, is to provide context on where the portfolio performance is likely headed going forward. Alan has mentioned a couple times in different ways today that one of the challenges facing CalSTRS as well as other institutional investors is the fact that everything has gotten expensive. Valuations have increased a lot, and so a lot of the investment decisions that staff is making is about relative value from one asset to another. And as the first chart shows, it demonstrates that through the past, almost all of the past cycle, real estate has had an attractive relative value to other asset classes, which has led to significant transaction volume, significant investor interest in the property type as well. And in particular, over the last year, it has gotten more attractive. As you can see, the spread spread relative to Treasury, which is essentially considered the risk-free rate, has increased. It's now kind of back above and well above the average spread over the long term, which is continuing to lead to a lot of investor interest in real estate. The chart below shows transaction volume through the first quarter of the year in the United States, showing that 2019 is lower than 2018, but the 2018 was a record year, and so transaction volume continues to be very heavy. As we dig into that further, we see the primary reason why transaction volume is down, period, in the United States is because of a decline in foreign investment in real estate, which is probably more due to the strength of the dollar at this point in time than real estate fundamentals in the United States. So all of this is supportive of pricing and value of real estate going forward, as we're going to continue to see lots of investor demand for it for the foreseeable future. And it's consistent with what investors are saying about the outlook for real estate as well. So what the charts that we're showing on the slide are the results of surveys of institutional investors, both LPs, GPs, and consultants, that forecast their expected returns by property type as well as by income versus appreciation. And what you see here is that the market is essentially expecting returns to decline, but almost entirely due to declines in appreciation. Essentially, we view that as the market saying, how much lower can cap rates go? Or in other words, how much higher can valuations become than where they are today? But they continue to have a great deal of confidence in the income that is likely to come from real estate going forward. And particularly when looking at apartments and industrial, there's a great deal of confidence in those incomes and in the returns over the long term. With that, happy to continue to talk about the market, but also want to open it up to questions.
Thank you, Taylor and Ben. I do have Controller Yee. Betty?
Just had a question on IND 208 about why we're overweight in the office and hotel sectors compared to the benchmark.
Yeah, I can answer that. So first off, there's not a lot of hotel in the portfolio. You're overweight in the hotel sector because there simply isn't a lot in the benchmark, and so it's a relative weighting. There's a very small amount in the portfolio in hotels. With office, it is the largest allocation within the portfolio, and that has to do with the large check sizes associated with office, along with the partners. And the partners have been able to source attractive deals in the office sector that has led to additional allocations. We'll get into this more in the closed session as well, so I don't want to spoil it here, but yeah, that's the primary reason.
Yeah, and I'd say really quickly that, maybe as a preview to the closed session, that we've talked extensively with staff about the allocation to office because we do share concerns about the property type. The reality is that, it's the property type that has led dispositions during the past year, so it's something that they're certainly taking seriously. And then B, CalSTR's office portfolio has significantly outperformed its benchmark office portfolio, which again speaks to the strength of the managers as well as the specific investments.
Thank you.
Anyone else? Stamkin?
Just one issue that was raised earlier, but I don't think there was enough discussion about the difference between pre-global financial crisis and today. Pre-global financial crisis, if you went to any major city in the country, there were cranes dotted everywhere. And there was a massive oversupply both of space and capital. That didn't exist. And now the market is a much more balanced market. In very few geographies do you see lots of new construction. And generally that new construction is coincident with leasing. So people aren't building spec buildings. And that really created more balance. And that's why there's less risk in that portfolio in part today than there was previously.
Yeah, that's absolutely true. We agree that's been driven by discipline on both the equity market side as well as the debt market side that has retained pretty disciplined lending requirements throughout the cycle, which has made it difficult for the cranes to go up like we've seen in previous recessions, as well as equity investors that have long memories of the pain that the previous downturn caused on the real estate portfolios.
Yeah, sorry, go ahead.
It's okay. Yeah. Gail?
Did you have, were you gonna add something?
I was just going to add that, that there is some additional detail in the report, in the appendix of the report on the market, and especially what Alan just said, which is that the space fundamentals in the current cycle today look very strong, especially compared to the last cycle.
Thank you, Mr. Chair. So a question on the investor demand that you say is still really strong. How does that translate to kind of where we are in terms of appreciating values and low interest rates? Those two comments were a little, seem to
sure.
conflict themselves somewhat.
Yeah, well, we actually do think that they are related. So we think investor demand for real estate continues to be high because of the relative benefits that it offers to other asset classes. The returns appear better on a risk-adjusted basis for real estate relative to certainly fixed income and potentially even public equity for many investors. And so that has led many institutional investors to increase their allocations to real estate. It's led to record-setting fundraising on the part of general partners, and that has led to just kind of sustained demand in the market. At the same time, low interest rates have enabled valuations to increase as well. So because real estate, just as an asset class, tends to be leveraged, doesn't tend to be leveraged, it is leveraged. That is what drives the asset class. To the extent that the returns from real estate can be enhanced by leverage, drives interest in the space. And that continues to be the case throughout the cycle as interest rates go down. So basically just supports more aggressive pricing.
I'll just add one note there, which is that there is a relationship between market capitalization rates, which is the yield on real estate, and interest rates, but there's a lag. So they don't move in tandem. That over time cap rates follow interest rates, but there is a time gap between them.
But the time gap would indicate that the investor demand may decrease.
Well,
Given.
Right. What would end up happening as interest rates have come down, the expectation would be that so the spread between what cap rates are offering and what interest rates are offering has widened, right, as interest rates have come down. So there's always the expectation that there's some reversion to the mean, and so that would imply that cap rates would continue to come down, which would increase appreciation of the asset class.
And just to add fuel to the fire.
Please.
If you look at it on a global basis, if you think that cap rates are attractive relative to treasuries domestically, compared to European interest rate or Japanese interest rate, it's a screaming bargain. So as long as you believe you're going to get your capital back, you're getting a significantly higher return than you would be investing in the alternative if you were neither in Europe or Japan. So there's demand for a whole variety of reasons for domestic real estate that goes beyond what a U.S. investor might be looking at.
That's right. The cap rates domestically are over 100 basis points greater than in other developed markets in Europe in particular. And so there is a chase of yield that's going on.
Okay, I hadn't thought about it like that. And then one other question on INV 215. Just on the co-investment, and I know we're moving in that direction. I can't even see what percentage that is, although how do you think co-investment has added to the high performance in real estate? And as we look at our current choices in asset allocation, I think that 15% target is realistic. How important is the co-investment piece to the asset class in general here?
It's a good question. It's relatively less important for real estate than it would be for private equity due to the nature of the vehicles that both asset classes can invest in. So I'd say on the part of, typically in real estate and in private equity, the co-investments occur alongside an existing commingled fund that the investor is already in. Because the real estate portfolio, the real estate program is able to invest directly with managers through separate accounts and joint ventures. There's no co-investment opportunity there. They're actually already investing in the assets directly, and because they have a relatively smaller portion of their overall portfolio invested in funds, they have relatively fewer co-investment opportunities as well. And they're not as important to accomplish a lot of the goals that they might accomplish on the private equity side, lowering fees, increasing increasing control, which again are the primary goals of the collaborative model. But again, real estate can get them in other ways. So that's how.
Real estate vis-a-vis private equity, are they as?
So I first of all describe it within real estate. So in a separate account or joint venture that CalSTRS makes directly with a manager, and we can talk about this in more specifics in the closed session, but in general, the fees can be half of what they are relative to commingled funds.
Thank you. Thank you, Mr. Chair.
Chris, yeah, go right ahead, Chris.
We, in November, you're going to get a cost report. We do something called a capture ratio as a way to try and determine for every dollar profit, how much do we capture versus our partners. We're only 3 years into that, so it's not a fully robust number, particularly on the long-term assets, but roughly we capture about 74 cents on every dollar profit in private equity. Real estate, off the top of my head, I think the number is 86 cents and improving, because real estate has more favorable structures not using funds.
Thank you.
Thank you, Chris. Mr. Prasant, Bill?
Yeah, thank you, Mr. Chairman. I don't know what questions we should ask here or what questions we should ask later, but one question that maybe can be answered here is, have we determined what the burn off of the closed-end fund legacy assets will be? And what that, when the end of that that will occur?
I think we're 2 years away.
Okay. And so in 2 years, we're looking at legacy funds are how much now?
They're 5% now. It's dependent on them actually returning capital, but that is the projection.
Okay, so it's returning capital. Are they producing? I'm sure some of them are producing income as well.
Yeah, there is I'll go back to it. I did gloss over it as we went through this, but over the past year, they did return 0.5% compared to the active portfolio of 8.7%, and then over a 10-year period, it's been 3.1%.
Yeah, and if you want to refer to INV 218, it shows staff's projection through 2021, essentially the pacing, which projects the legacy portfolio getting down to 1% by that time period. The projections have consistently, I think, been more optimistic regarding when that legacy portfolio would draw down, largely because the legacy managers have used different means at their disposal, as well as the argument to drive as much value out of these assets as possible to extend the investment periods in periods in which they can own the assets. So while it's certainly in CalSTR's interest to just be done with the legacy portfolio at this point in time, it's again not under CalSTR's control, and CalSTR's is largely subject to the manager's ability to sell those assets and return the capital, ability and willingness to sell the assets and return the capital.
And one other question that's a bit off the wall. We're not subject to any recapture, are we, on the sale of an asset? I mean, no.
In the legacy portfolio or otherwise? No.
Or otherwise? I mean,
no, that typically would not be a term.
Like a for-profit investor might be. If you depreciate the asset and you refinance and you take that dividend out, and you're going to have that recapture issue at the end on a sale, aren't you?
The only way in which that could happen is if the value at which that asset is marked on CalSTR's books ends up being higher than the ultimate disposition value. So there might be a hit at that point. For the most part, those value losses have already been realized, and these funds have largely run out of their ability to call any additional capital from their limited partners for that purpose or any other.
Is that it, Bill?
Thanks.
Okay, thank you. I don't see anyone else in the queue. Thank you, Ben. Thank you, Taylor.
Thank you.
Next
Thank you.
presentation on the semi-annual reports are from Steve Hart from Makita Private Equity.
Good afternoon. Steve Hart from Makita Investment Group. Good to see everybody today. What I'm going to go through today is the set of reports that we had put together for you on the private equity program. Similar to the real estate discussion, all the valuations and numbers that you're going to see here are actually as of March 31st, 2019. Similarly, the topic that the values that are received from the particular underlying managers are lagged by 3 months or so. So that's why we're reporting it as of that time frame. So we've got some documents today. I'm going to go through this presentation, which is a summarization of a report which begins on INV 240. On that, we've got kind of 3 sections in our report that I'd refer to. The portfolio itself, 242 through 248, the performance 49 through 54, and some activity-related information on 55 and 56, and some appendices on there in terms of the portfolio, and also some market details, and I'm happy to go through that as this comes through at the end of the presentation. So I think flipping the page here, wanted to talk about really 3 points here as I go through the presentation. As it's been noted in several of the discussions here, private equity has been your strongest performing asset class in all time periods. So in INV 66, you can see that that's outperformed on 1, 3, 5, 10, and year basis. I think that one of the things that we identified when we came on board a few years ago was that additional work needs to be made to position the portfolio to actually start to grow. I think there was 2 things on that. One was that in prior periods there were many years ago lots of commitments. Those had been fully deployed and were returning capital at a very rapid rate, and I'll do a slide kind of showing that. As well as there was not as much commitment to the private equity asset class in the intermediate periods, 2010 to about 2014-15. Since then, CalSTRS and staff has been working to deploy additional capital, and as you may know, that the primary way to deploy capital is through funds, which are drawdown vehicles, meaning that essentially CalSTRS and other limited partners essentially give a checkbook to the investment manager, and that manager writes checks out of that checkbook when they find interesting investments for them. So what that means is that you make a commitment today, those checks might not get written for several years. So it takes some time before you actually get the investment in the ground. What has happened is that the results of that are starting to make themselves clear, and we're seeing that the portfolio as percent of the total plan is ramping up. It was 8.4 in the last 6 months semi-annual period, and it was 8% a year ago, and now at 9.3. What that actually represents, just both the numerator and the denominator have changed, but the numerator, meaning the amount of private equity assets, has increased by $2.6 billion. So meaning that there is more assets getting put into the ground. The last thing I would just wanted to touch base on in the presentation here is that CalSTRS staff, through the collaborative model, is looking to address a key issue in private equity we talk about is the relatively high fees, and looking to use that as a way to help mitigate some of that high fee by deploying capital alongside chosen partners, alongside those funds to get additional exposure to those investments, but also doing it in a very fee-friendly way for CalSTRS. Here are just a summary on the performance here. The main focus is on the long-term return, and I'll get some data points later on here. But one thing of note is due to the roll-off of the prior periods, 2008 time periods, the 10-year performance has risen dramatically. So since 6 months ago, it's up by 400 basis points. Since a year ago, it's up by 600 basis points. It's just showing that kind of roll-off of taking place at that particular time period. As we had done, several meetings ago, talked about changing to the peer benchmark, the custom State Street benchmark. The performance of the program is much closer to that custom PE index than before. Largely, the biggest impact has been in customizing the portfolio. The index has been to help adjust that index for the vintage year differences between the index and the CalSTRS portfolio. So just getting a more representative focus of what the actual investment benchmark should be. It's closer to what CalSTRS program is like. In terms of the activity, we'll talk a little bit more about this in a couple slides, but that the program experienced a net negative cash flow. So that sounds kind of bad, but what it really means is that there is now more dollars going into the asset class than they're getting back. So in other words, contributing more into the investments than getting in terms of distributions. And we'll show in a couple slides that there's been a big headwind in terms of being able to get more assets in the ground, as that there's been more capital being returned and profits being returned. So we'll look at the number in a couple slides, but $20 billion of profits has been returned back to CalSTRS since 2011. And that's just that process, being able to deploy additional capital while there's been a lot of capital coming back, has been a challenge. Now that is equalized and kind of measured out.
What was the return of capital since 2011?
What's been the IRR return?
No, what was the return? 20 billion?
$20 billion, right, has been in net returns. The last thing in terms of the activity here, the staff has been busy. It's been an active year for staff in terms of deploying capital, and they made commitments of $5.5 billion in the first half, calendar half of this year. Here, I just wanted to touch base on a couple of points here on this slide. There's a lot of numbers here, but I think that what we're showing here is what the portfolio kind of looks like from a couple of different dimensions based upon the strategy. So buyouts is going to be by far the strongest part and the largest part of the portfolio. First overall is that the different asset classes, the strategies are within their target ranges. The special mandates looks a little bit odd in that particular segment is looking to be decreased sort of over time. So the 7% target is being updated as that portion is being shrunk a little bit. But as we've talked about before in prior discussions, The two newer asset classes are strategies, the core private equity, now called longer dated, and the opportunistic private equity called multi-strategy, are newer ones that staff has identified to, again, try to expand the range, expand the set of tools that it has to be able to deploy assets into the market. And as I mentioned before, the remaining value, meaning the total value of the portfolio as of March 31st, is up from $18.7 billion and had gotten as low as just under $17 billion. So we can see that the amount of assets in the ground has increased. Next, I want to turn to the slide. I referred to this a little bit here. So what this shows is over time, on an annual basis, what the cash flow dynamics have been looking like in the portfolio. And what this means showing is that the blue bars going down are showing contributions of capital into the program, and the bars in the top are showing distributions of cash back to the to CalSTRS. And you can see that time period, roughly 2011 to just into 2018, where the vast majority of capital has been positive, getting capital back to CalSTRS. There's still been deployments of capital, but it's been outweighed by the amount of capital that has been returned. You can see that in 2018 and 19 that is beginning to turn, and it may fluctuate a little bit, kind of right around zero, but we expect that that's going to turn and be more consistently where there's contributions being made into the program in terms of net capital. Here we talk about the performance. As we can see here, the performance on an absolute basis has been quite strong. And we see that the since inception, there was a question from you, Ms. Miller, that what has been the long-term performance. So the first investments that were done by CalSTRS in private equity were in 1998. So what this shows is 13%. It's an IRR basis, but it's showing that since inception, the program has generated a 13% annualized rate of return on their assets. And again, this has been stronger than your global equity returns, and looking at INV 66 to compare that. But against the benchmarks here, we have two of them, the custom State Street PE index, which again is customized to reflect the CalSTRS portfolio dynamics. That return is really close to the portfolio. The portfolio is quite close to that within spitting distance, and that's been getting a little bit closer. And I'd also want to comment against the benchmark. Again, this is a bit of a Frankenstein monster in that the way it's constructed is whenever it's changed, it's never changed retroactively. It's just whatever new benchmark is decided for this particular asset class, it's added on. So that's one. The other is this is not something that's investable. It's not something that you can go and you can find off the shelf and say this is something, an alternative that we could do. So it does have some characteristics that make it somewhat challenging to compare to. But we do recognize that if we say on the 10-year basis that the return of the CalSTRS program at 14% per year, that compares to the new long-term private equity benchmark from a proxy basis, the public equity there, the ACWI index, that would have returned 12.3%. So we're seeing in retrospect that the private equity program has outperformed more than the spread, more than the 150 spread. It's about 170 basis points against the new public equity benchmark.
If I can jump in, Chris Allen, Chief Investment Officer. Gail, I think one of your questions was how has the private equity portfolio done by year? And that's available to you on INV 257. It actually shows the vintage years, the number of investments, the amount we did, and then what our return was at the program level net, and then what the index did, all the way back to good old 1988.
So that was all the comments I had in my report here, and happy to answer any questions.
I think it would be helpful, I don't know if it's been sent out, but I did put in a request at a prior meeting, the Makita report on the performance of private equity to a public market equivalent that you did a couple years back, I think would be helpful and beneficial for the entire committee to see. I don't know if it's on the board website or not, but perhaps staff could just email that out. It was a request by the committee to see whether or not the risks we were taking in private equity, and it was net of fees, and what the outcome would have been had those same dollars been invested in public equities.
Correct.
And as we're moving towards some action towards our asset liability study and adoption in November, that might help give additional information to those of us on the committee that weren't here when that study was done, because it gives real dollar amount and shows whether or not private equity has done in the past what we had expected it to. No guarantee it will do it in the future, but that report is an independent report that I think provides valuable data and information. So if the team could get that sent to everybody on the committee, we'd
I'll
appreciate
coordinate
it.
with the team on that. I think that we've made that available, but we'll make sure that it gets out to the board.
Thanks.
And then just to highlight on that, the number, because it was significant, sticks in my mind, over $13 billion of additional value was created by the private equity program compared to investing in public markets.
Thank you. I know there's a couple of committee members that may have questions. Bill?
Thank you, Mr. Chairman.
Yes, sir.
95% of the portfolio is invested in funds presently, is that correct?
I think that's correct, yes,
Yeah.
versus
And
co-investments.
which leaves, what, 5% in co-investments?
That's about right.
Okay. So if we go over and we look at, let's see, INV 248, we have our largest manager relationships. And one fundamental question I asked at the last meeting. In each of these private equity sponsors that are listed here, for example, is the fee structure 2 and 20?
I can say with quite a lot of confidence that it's not, it's lower. And the reason is that I can say that without necessarily knowing what's on this is that most of these are very large managers, and those managers have recognized that they don't need 2% to
So
run
what
their
would
thing.
be the management
So
fee?
it'd be somewhere between 1.5 to 2 would be where those tend to
So
be.
it's 50 basis points.
Something of that
Yeah.
nature, right?
And then that's on committed capital?
That's on committed capital.
So if the commitment is $1 billion, that's 1.5% on $1 billion. That's paid quarterly.
That's how that's structured, and the way
Whether the money's invested or not.
the way the money, that's how that has been structured in the industry. That's correct.
And can we have, maybe at the next meeting or at some point, with regard to each of our private equity sponsors, since 95% of the portfolio is invested with those sponsors today, the fee structure and whether there's a European waterfall and all of that? I mean, just to get some idea of where we are in terms of net of fees.
We could give you information that would be confidential, but we could give it itemized. There's 250 funds, but we could also generalize.
Yeah, well, I mean,
And tell you how many are
the major
European.
funds.
Yeah,
with whom
other
we're
major funds,
invested.
sure. We have, it's much less than 1.5%.
Just to jump in quickly, I'd confer with our legal counsel, Brian Bartow, but it might be best to cover that in a closed session.
Okay,
For specific managers, right? Mhm.
okay. I got no other questions.
And I think in a maybe